Hello, everyone. Welcome to another episode of The Bridge, the official 107capital podcast. My name, as always, is Tyler. This is Timnihill, our founder and CEO. And today we're going to be talking about a very special subject near and dear to everyone's hearts, year-end tax planning.
Taxes, yes, let's go. Diggs, what do you think of taxes? Boo.
Yeah, we got our little buddy Diggs here. He's kind of our little mascot today.
Yeah, he's wearing his County Clare shirt. So, I'm Clare, West Coast Ireland, baby.
We went to Ireland for 2 weeks, and he won't stop talking about County Clare.
That's where my family's from.
That's fair.
That's fair.
All's fair in County Clare.
That's true.
No, but, I mean, it's a common saying, like, nobody likes taxes, but everyone likes keeping more of their money, you know? But the common saying is, you know, I'll just deal with it when I file, right? How many times have you heard that from clients?
All the time, yeah. It's kind of funny. I never agreed with some of the lines that you hear growing up, like the line, there's nothing more certain than death and taxes, and I'm like, that's one of the most ridiculous things I've ever heard. Like, I disagree with that wholeheartedly. And when we talk with people about taxes, and this is the importance of it, like, your tax planning does not start January 1st, the year after when you're going to file. It doesn't start when you file your taxes in April, right? Like, tax planning starts to happen January 1st, the year that you're in. Oh, he's going to run. And then it goes through December 31st.
He's not much of a tax dog, is he?
No, not really. I think he smells food. But the point is, for every tax year you go through, everything has to be wrapped up by December 31st. I would even say 10 days earlier through year end, right?
Yeah, December, not April. That's when tax outcomes are actually shaped.
Yeah, and if you're with the right group and doing it properly like we do in our family office, it's like our tax planning happens all year round, right? Because there are things that happen throughout the year. You know, you have capital gains distributions, you have sales of properties, whether it's primary rental properties, you know who's going to have high income going in. There are any number of things that happen, like you get large capital gains distributions, which are kind of annoying at the end of the year. Like, all of a sudden you'll get a call and, oh great, I just got a check for $300,000 and I have 15 days to figure out what the impact is on my taxes, you know, whether it's K-1, 1099, etc. And then, okay, I basically have 15 to 20 days to figure out how to take that tax bill as low as possible.
Yeah.
Right? So, like, if you're, and this is the problem in the accounting arena, like, and I grew up in a family of CPAs and an accounting family. I know two things. I know I'm not an accountant. I was never good at it, which is really hysterical.
Oh, me neither.
And I also know how to identify poor accountants and really accountants that are bean counters, for lack of a better term. Right? They just count your beans, tell you how much to pay.
Takes one to know one.
Oh, you know what? You have to prepay estimates every year, so you should take, you know, that money and send it to the IRS and the government, which means your money's not making money for you. And I don't think, especially Americans understand and investors understand how leaky their finances are because of their accountant and financial professional. And it just got to the point for us this year that, you know, we brought all of our tax planning in-house now because we're just done trying to, you know, work with other professionals on these types of strategies, because a lot of them don't know about 1031 exchanges, opportunity zones, land leases. They don't know about, you know, carbon offset opportunities, you know, drilling programs, energy programs, which are a really, really big deal, especially as we have this whole new wave of infrastructure.
Mm-hmm.
So you should never be at the point where you're cutting checks to the IRS for hundreds of thousands of dollars.
Let's kind of break that down.
And yeah, sorry, go ahead.
No, I was going to say, let's kind of break that down a little bit. There's a lot of concepts kind of packed in there. I'm kind of wondering, I think we should probably start with some common misconceptions, because you hit on a couple just then.
Yep.
What are some, would you say, common misconceptions as it relates to what clients will often say about their tax planning process?
Yeah, I would I would say common misconceptions. I mean, first and foremost, a 401k and a tax-deferred retirement account, these are not tax strategies. Like, it doesn't make any sense. Okay, so if you put $100,000 into a 401k and it grows to $1 million, right, as an example, you now have to pay taxes on that $1 million. Now, people look at it, they're like, oh, I have $1 million in my 401k. And I'm like, no, you have $500,000 because the government is the other owner of your retirement account. These are tax-deferred IRA accounts. These are, 401k accounts. But everyone has been trained and programmed to auto-default their paycheck into these things. And my question is, like, why wouldn't I just take my $100,000, do tax planning strategies? So let's say I'm paying, I don't know, $20,000-$30,000 in taxes on $100,000, and then I'm going to grow my $100,000 to $1 million, and then I'm not going to pay taxes because I'm going to be doing so many things from an investment perspective. And it's all allowable under the Internal Revenue Code. It's just we know how to read it.
Yeah, it's a mindset shift.
Right. And the whole thing is you have to think about you're playing Monopoly, right? So you want to be in a position to where your money is staying in your pocket. It's making you money, whether the growth, income, or a combination of the two. And this is where we share with people, like, performance doesn't matter, right? Everyone's like, oh my gosh, my S&P is up 20%, my Vanguard fund. And I'm like, well, you still have to take out 30% for taxes. Mm-hmm. And God forbid if you live in Massachusetts, California, and New York State, because they layer upon tax upon tax upon tax, where, oh, you're a high income person, so because you're going to sell your property and you're going to have a larger capital gain, well, guess what? We're going to tack on this magic 13% tax on top of the state, income capital gains taxes that we already are charging.
Yeah.
So, you could look at it, and this is becoming a big thing with the older baby boomers that have to downsize, right? Okay, so if I'm in Massachusetts and I bought a house for $500,000 and I just sold it for $3 million, you're dealing with a $2 million reportable capital gains bill. So at that point, people that are older, they're not working and earning income anymore. They need that money.
Yeah.
Like, that's their safety net. So you have to be able to convert that primary asset that they had as the foundation of their entire wealth strategy for that generation into not only another property, but then you have to keep that money in their pocket so they can live off of it. Mm-hmm. And when you look at these tax bills, they're insane. I mean, we're working on another one. Someone came to us, then they sold a property in Massachusetts, and I mean, you're talking. And this is the thing people rental properties, they forget about depreciation recapture.
Yeah.
So, property is sold. Let's say the capital gain on it is about $300,000. They've been renting it out for about 13 years, and then you have a $150,000, $250,000 recapture because you were depreciating your rental asset. Mm-hmm. So now your capital gains bill plus the depreciation recapture just doubled. And now you're looking at federal, state, income taxes, and then because the person doesn't live in Mass, they live somewhere else, and it's a mess. They
find any way possible.
It's like $150,000 tax bill across federal, state, and all that stuff, and no one wants to pay that bill. Like, taxes have gotten out of hand, and that's why the other misconception is your tax-deferred retirement account in 401k is not a tax strategy. The second part of that is you don't generate wealth and net worth through investing in the stock market. You accelerate your wealth generation through tax planning, mm-hmm. right?
Especially proactive tax planning.
Right, proactive tax planning.
That's why year end is so important, and we'll get into that in a second.
And it all starts before April of every year hits. Like, if
Absolutely.
You're waiting until April when you file, it's way too late, and you've already lost so many options and alternatives out there.
So this brings me to sort of another question that I have, as it relates to the process itself, because obviously there's a lot that goes into finding the right time. Like, you want to make sure it's proactive. Year end is probably the best, as we've established, but even so, there's still a lot of mistakes that can be made. What, like, obviously, we help a lot of people with their year end tax planning. What mistakes might you often see as an advisor, from people who will still do year-end tax planning? Like, are there any mistakes that come up because it's happening then, or just mistakes that you'll still see that you can't really avoid regardless?
Yeah, I think mistakes can happen by waiting too long. Like, before you make a major decision, that and we see a lot of this in the business world when people get their buyouts and they sell their businesses. Like, that sale is coming. That tax bill is coming. So before you even get to year end, by the time you get to the execution date and you're paid out for, your ownership percentage in a business or a property, or, whatever it is, you should already have a pretty good idea of what your tax offset strategies are going to be. And it's just a matter of, even waiting through year end, you always want to give yourself a little time in case something goofy goes wrong. Oh, like the paperwork we filled out to do something didn't go through, so now we have to redo it. Or, people that cut it close to getting investments done by the end of the month in December. Oh, the wire didn't go through, the ACH didn't go through, the property that I was, investing in as a 1031. The check never made it. So
Yeah.
now it's all of a sudden January 2026, and unfortunately you can't go backwards in time with these things.
Yeah, it's always the little things.
Yeah, it's just little goofy stuff that can happen. Yeah, it's just, there's so much to the tax world, but if you can cohesively, as we do in the family office side, put together everything to where it's working together, you can really, really dial up your tax or your tax efficiency over time. And I mean, we're looking at too, like, we're not looking at just today too, we're looking at 10, 20, 50 years out, right? And we're able to put, in some cases, millions upon millions of dollars into family wealth and people's family offices for themselves that are tax-free, tax efficient, managed risk. And when you start to do these, and year over year over year, even if it's incremental, mitigating and managing your taxes properly exponentially X's your wealth.
I want to touch on something you just said as well about the impact that the family office structure in particular has on year-end tax planning.
Yeah.
In your experience, what have you seen from the year-end tax planning process as far as the family office structure goes, where that structure particularly impacts the process, and how does it impact the process?
I would say because we're able to see everything together, that we're already planned out before the decisions are made.
It's that simple?
It's that's the biggest part of the entire thing. Like, you're not chasing down your CPA or advisor. Advisors will say, well, we do tax loss harvesting, which is great, but if I'm an individual and you're managing my money, and I'm saying, okay, I have $1 million capital gain bill I have to offset, and you're going to tell me I have to sell $1 million in losses, I'm going to ask the question, why is there $1 million of losses in my portfolio?
Yeah. Why are there losses to begin with? What are you doing?
Right. Like, I get it. You can. I just have a different viewpoint on kind of like the art of investing and technical versus fundamental and all that jazz. But, you can buy and sell and capture gains and offset with losses and short-term losses from an investment perspective, but that's not going to give you the real impact of tax planning when you're using tax efficient strategies, tax offsets. The other thing we work on a lot with people that have advisors is they get caught onto the we call it the DST train. So their advisor came in, hey, you sold a property, we'll 1031 the property, throw it in the DST, let it run 5 to 7 years. The property comes full cycle, or the investment goes full cycle in the DST, and then they have to find a new one because you're just continually kicking the can down the road. We take people and get them out of that cycle, right? And we get them into the, where the capital gains is offset into perpetuity. Their investment is invested into a structure that operates in a perpetuity, and they're not having to worry about being resold a new property every 5 to 7 years.
Let me ask about the perpetuity aspect as well, because obviously that is an aspect of the family office structure. We're really trying to create generational wealth for our clients.
We're not trying, we are doing.
Yeah. No, it's happening. But you know what I mean.
No, and I tested the thesis with some of our early clients, and I said, we're going to do this. And we went from, incrementally growing to 10xing people's wealth. Mm-hmm.
But I guess what I'm wondering is, as it relates again to the process, when it comes to that specific multi-generational aspect, because part of it when you're with a family office, you also have to plan, with spouses and generations. You have to really look forward, like the proactivity extends to the next generation. Where does that aspect kind of come in?
The multi-generational piece all depends on each family component and how close they are and who directs what and how involved everyone is. So the good news is typically, like when you're building your own family office, the family has a philosophy to it and a structure to it that it has an operating structure. So you're basically giving life to the family trust, if you will. From there, it's just an efficient way to pass assets down to the next generation and protect them. So it's very much aligned around capital preservation, right? Because you don't want your estate getting clipped for 50% by having a poor estate plan.
Oh yeah.
You don't want to get clipped and losing half of your money through retirement accounts. Like in tax deferred accounts, you used to be able to stretch out your beneficiaries into stretch IRAs, as we call them. And then I think that this was a terrible idea, but during, I think, the Biden administration, they came in and got rid of the stretch IRA. So now beneficiaries have to liquidate all inherited tax deferred accounts for non-spouse beneficiaries. They have to take it out within 5 years. Right? So think about that. Okay, so I have $5 million in a retirement account. My beneficiaries are going to have to take out $5 million within 5 years. That's $1 million of taxable income year over year. Now watch what happens to their tax bracket, right? If you had someone that's in the 24% tax bracket, then federal goes to 38.
Yeah, and they're going to take as much of that as they can.
Yeah, and they're just going to get absolutely crushed by taxes. So capital preservation, the fluidity of the estate plan and passing on the assets generation after generation. And then from there, you also have to remember, like, there's still a lot of people out there that do philanthropy, charitable giving. I mean, even structuring and building your own charities, right? We know people that we work with that have a massive love of pets. Even your mom wants to do this at some point. She just wants to have her own little doggy shelter or doggy hotel. Who knows? It'll probably be specific for Yorkies. But, you also have the charitable side of things, right? So you get the generational planning, the, passing the assets, fluidly. You get the estate and capital preservation and estate protection, so then you're not losing half your assets. And then it's just the efficiency of, the transfer from one generation to the next.
Yeah, I mean, like...
Through the right structures, and we're telling you again, get out of retirement accounts.
But I mean, not only that, but it just matters for, like, basic peace of mind for the family. Like, there's less complexity you're seeing, there's fewer surprises, and that leads to just more confidence in decision making.
Sure. Yeah, 100%. And when people, and we see it all the time, like, when you can get to the point where you're able to really grab a handle and get a handle around your tax strategy, and you use the Internal Revenue Code as your friend, not your foe.
Mm-hmm.
You're being more proactive versus reactive. You're getting out of the mindset of how can I use the tax code to put more money in my pocket this year and invest better and allocate better. And then you're not just sitting around waiting for every April to cut a check and pay estimates.
Yeah, exactly. I mean, and that's where family offices come in such an important role, because when you have the right family office with the right structure and the right mindset, the family office acts not really as a silo, but as a quarterback.
Yeah.
And
Yeah.
that makes all the difference.
And especially when you're doing everything in-house under one roof, the communication piece is way better. And at the same time, like our people and tax professionals, I mean, we're studying tax opportunities all year round, right? Like we go to seminars, we go to conferences, we go to due diligence events. We have different days focused on different opportunities. Like there's Opportunity Zone Day where you have, in our world, an entire day of just investments and platforms out there that are doing these types of strategies coming to you and saying, here's what we're building that qualifies as an opportunity zone. We're kind of getting through the first wave of opportunity zones this year, 2026, and then there's going to be a new set of rules around them going forward. But these are all investments that are available to high net worth, high income, accredited investors, qualified purchasers that when you've been able to really build a core foundation and then you add the tax strategy to it and the planning piece to it, and you can keep as much of that tax money in your pocket, then you're just going, instead of incrementally growing every year, you're going boom, grow, boom, grow, boom. And you get to the point where you're like, I don't have to work if I don't want to.
Yeah, exactly.
And I think that's the most important thing.
So here's another aspect I kind of wanted to touch on as well, because obviously, there's that element of the family office is learning just throughout the year. There's all these opportunity zones, there's all these things that we're looking into to try and give the best advice and proactive planning for clients, as we can. But obviously, when it comes to going back to the multi-generational aspect, going back to, passing that wealth on to the next generation and doing the planning accordingly that needs to be done for that, what part do family offices have as far as teaching that next generation, how to think about wealth responsibly? And what have you seen in that aspect?
Organization, structure, and philosophy, right? Like you have to have a family philosophy, right? And like in our world, we talk about the difference between the Rockefellers versus the Vanderbilts.
Does that have to be like a family constitution a la Succession, or can it just be a set of values?
It depends on each family, honestly. It depends on each family.
Mm-hmm.
Like you'll have families that will have very, very tight core units, and they get their children and grandchildren involved with the estate from a very, very early age, and they teach them about money and how to properly run the estate, right? They will have a core philosophy, they will have the structure, they will have the organization, and they will have the increased probability that their family office and wealth will extend 7 to 10 generations out. Then you have the other side of it that has kind of like the ne'er-do-well. They're people, the next generations are out there floating, they don't care, they don't want to be involved. The Vanderbilts were a great example of this. They didn't really have that core philosophy and structure. So if philosophy is not going to hit the next generation, then you have to overcome it through structure.
Mm-hmm. Yeah.
And through structure, that means that the ne'er-do-wells, or even people that are dealing with, challenges, I think of substance abuse as a really big problem right now, especially with the younger generations that people are having to plan through. You have to overcome some things through structure and organization, using the right trusts. donor advised funds, charitable strategies, things like that. But then at the same time, it's still keeping the money protected within the family unit. So maybe it skips a generation, that generation's taken care of, and the generation after that gets re-engaged, and they take over the philosophy and the structure of the organization.
Yeah, I mean, you have these older families like the Rockefellers and the Rothschilds, like all of these very public members who, like, they're all very tight knit and they all talk to each other, and there's that organization there. And then you have, like you mentioned, the Vanderbilts, who is like, I mean, I feel like everything we see of the Vanderbilts these days is like, pictures of old Vanderbilts that are dead, and like the only one I think anybody knows is like Anderson Cooper. He's a journalist.
Yeah.
Like,
hey, you know what?
Great for him.
Journalist for CNN's not a bad gig.
Yeah.
But I think the real thing is conceptually, think about it this way, like especially if you're a high net worth, ultra high net worth family, you want to step up and graduate up into the family office. So instead of you sitting there and thinking about you with the financial plan running around you and extending the day that your money goes to zero out as far as possible, what you're doing is you're basically taking your last name and breathing life into it and creating a financial life for the name.
Yeah.
And the name and the entity around your name becomes the living, breathing organism, and then you're just building that organism, feeding it, and allowing it to grow.
Yeah, I mean, that's where...
It's like planting a tree.
Yeah, and that's where year-end planning comes in, because you're basically watering the tree, well in advance, as opposed to like, oh, it's time to water the tree, quick, let's go, we have to water it, and then you go outside and you water it, and you find out, oh, it's like half the leaves already falling off, it's half dead already.
Yeah, it's like trying to grow, food in a garden when half the garden's already burned out from the summer crop and the heat.
Yeah, exactly. And not only that, it's not just about, when it comes to year-end tax planning, like, it's not just about, that year in particular. It's about building good habits in general. It's about, that more lasting impact, because if you do it on a more proactive basis on any given year, then you'll understand that process. There's more of a chance that you're going to do it proactively every year. You're building that routine.
Yeah. No, in our world, we already are planning out January, February, and March of next year, because we have, people that are making changes to their lives and where they live and all that good stuff. And they have, rental properties, vacation properties that they're looking to sell. And so we're already starting 2026 planning in December 2025.
Mm-hmm.
So we're not waiting until April of 2027 to deal with a tax bill. We're going to have proactively planned out everything that we need to beginning of next year, going into next year end. So a lot of, it's an ongoing process. It's never, let's wait till the end of the year in January through April and file.
Mm-hmm.
Like, you manage these things as you go along.
Yeah. Here's a question for you, a little bit more lighthearted. What's a funny sort of, I guess, an example of each side of things, an example of what to do and what not to do that you've seen in your time in the industry, without naming names, obviously.
What to do, not to do?
Yeah, an example of each, if you can think of one.
In terms of tax strategy?
Yeah.
What to do, what not to do. It's very simple. Hire a tax strategist, not an accountant. What not to do? Don't hire an accountant. Someone that counts your beans, tells you to prepay your taxes every year, and then files and tells you how much to send to the IRS each year. Like, that unfortunately is most of tax strategy, and at the same time, that's where your biggest financial leak is. So if you want to start early and plug it up immediately and see impact, hire a tax strategist, right? Mm-hmm. We have one on our staff.
Yeah.
Strictly focused on tax strategy. And then we bring in our own CPAs or if our client has their own CPA, we bring those people in and work with them through it. But tax strategists, not accountant. And just because they're a CPA doesn't mean they're a tax strategist.
Mm-hmm. But not only that, but like you got to ask better questions of your advisors as well. There's a proactivity from the client side as well that you need to see.
Yeah, I mean, when you're working with a financial advisor, you cannot assume that they know tax strategy. And in fact, I would specifically ask the questions of if I had a financial advisor, I would say, okay, how are you going to manage and mitigate my taxes year over year? Like, let's say I'm making $1 million this year. How am I going to bring that tax bill down? Right? Because what's $1 million? $1 million is what, 35 to 38% federal tax. So that's $350,000 to $380,000. Like, the amount of taxes we pay in America is insane. It's nuts. Like, how we got here just still mind boggles me. But like, okay, you make $1 million, then you have to pay $380,000 in federal tax. If you live in a state like New York, Massachusetts, California, then you have to pay at least another 8 to 15% tax. Plus, you're paying almost 15.3% OASDI. 7.5 up to what, like 125,000 this year, plus 15.3 on $1 million. Anybody get it yet?
Ever so slightly.
And that's where your 401k account is not a tax plan. It's not a tax strategy.
I feel like we could do a whole episode on how horrible 401k accounts are.
We should. I'll open up the entire hood on 401ks, and I'll tell you how the industry was hijacked. I built it from the ground up when we were starting, and then it was hijacked by the government and by Vanguard.
That one's coming.
Yeah. I'll open up the hood. I'll give you everything. By the time you're done listening to me on 401ks, you'll never put $1 in them.
Mm-hmm.
And the entire system is actually set up to make sure your money stays in those 401ks.
To feed the beast.
Because anytime an advisor goes in and recommends you roll a 401k out, they have to meet suitability requirements that are made up requirements by FINRA and even the SEC to keep money in the 401k plan so they can auto-default, auto-escalate, and put your money into a target date fund that doesn't work because it was just newly created and invented so the investment management firms can gather assets and charge fees.
As someone who works in compliance, my God, I have heard far too much recently about suitability requirements.
Yeah, but I mean, when you open up to really how the game works, you start to change the way you play. And, people ask us, where's our bread and butter? What do you do? It's 1, we do virtual family office services for people. 2, we do tax strategy. And 3, we do investments in digital assets, alternative investments, and real assets first. Mm-hmm.
And you guys are going to be seeing a lot of discussions more based on those 3 pillars. We're calling these really the 3 pillars of 10-7.
Yeah.
You're going to be seeing a lot more episodes talking about those 3 pillars and how each of them are important. So we kind of wanted to start with a little bit of a tax-focused episode today.
Yeah. And for us, if you hit those 3 pillars, you're well on your way.
Mm-hmm. So I guess to close, what would you say is probably, like, if you had to, let's go back onto the 3 pillars theme. If you had to say, what are the 3 pillars of a good tax strategy, what would you say those are?
1 is awareness, being aware of what your tax bill is going to be for the upcoming year. The second part is already having a plan in place and pre-planning everything out, right? So, like I just said, we're already starting tax planning for 2026, and we haven't gotten out of 2025 yet.
Yep, that's where year end comes in.
And then third, it's communication. Everybody on the same page, communicating, here's what we're going to do, executing, and being on your way.
How does that look like day to day?
Yeah, I mean, it varies. It mostly is tied around what did we do in 2025? What changes in 2026? Is there anything new that we expect to happen along the way? Business liquidations, sales of property, collectibles, physical assets, real assets, things like that are going to create any sort of large taxable income or capital gains event.
Mm-hmm.
And then from there, just everyone on the same page with running the estimates, running the numbers, and crafting up a strategy to minimize your tax liabilities and maximize your tax efficiencies.
Yep. I think there's no better way of saying it. So I think that's kind of where we'll leave it off. I think we've crossed the bridge for today. As always, I am Tyler. This is Timnihill, our founder CEO.
Go Bills.
Go Bills indeed. We hope you enjoyed. We hope to see you for the next episode.
Did it hurt for you to say that? Go Bills?
No, not at all.
Pats fan?
Oh, no, not at all. I stopped being a Pats fan years ago.
Oh.
If you want to talk about sports things that hurt, listen, we're recording this right after the day after John Cena's last match. That hurt.
Oh, yeah.
That hurt to watch. That hurt to watch.
He lost, right?
Yeah, he tapped out. I mean, there was a whole acceptance angle to it, so I get it, but like it just hurts. It hurts to watch.
Going out tapping out though, you can't have him go out on top.
Well, I mean, it kind of the whole thing is like he's old, he can't do it anymore. He's accepted that his time is up. I get it, but it still hurts.
Congrats, Sean. Glad you had a great career, man. It was fun watching you.
Hell yeah.
He's an awesome actor, awesome wrestler.
Mm-hmm. And he's still going to be in the movies. He's not going anywhere.
Oh yeah, just transitions to something new.
But yeah, speaking of
what you can do going into 2026 with your tax advisor.
I was about to say that. You beat me to it. But yeah, as far as transitioning into something new goes, yeah, I think we've definitely crossed the bridge for today. So, like I said, my name's Tyler. This is Tim, founder and CEO, and we hope to see you soon.
Thanks everyone. Cheers.
Thanks for watching.